Management and joins us now with more on how he's approaching the market. Dec, nice to see you. What's the common question you're having with clients right now?
Well, great to connect. The common question really coming up, and it's, somewhat a surprise, but given all the volatility around what's happening in policy, no one should be surprised. Where clients are trying to figure out, is this a growth scare, or are we seeing a situation here where growth is going to really deteriorate from here, or is this just tariff volatility that will eventually settle out and we'll be back to a more normal state? That's the most common question that everybody is asking right now, and in response to that, I would say first and foremost, it's tariffs. But that, of course, will bleed into growth and obviously reduced investments. There's no question consumers have turned cautious, companies have turned cautious. And there's a lot of data that's pretty mixed, and it was heartening that we've got a solid payroll number this morning, but it'll be the March number that'll be more relevant in terms of DOGE cuts and all of that. But when you look at the Beige Book, which is a pretty relied on, survey of what's happening across the 12 Fed regions, and the Fed themselves read it very closely, comes out quarterly, and it's pretty much this narrative and wrap of what's bothering companies. And the main thing on the minds of companies is not recession, but it is tariffs and the uncertainty that brings. So that's the stage where we're at, is that everybody is thinking, okay, we got a solid underlying economy here. Let's just not mess it up. But all of the tariffs and everything is playing out so publicly and so erratically, and it's on, it's off. It's all, I know, part of the negotiation, but that's what's unsettling investors, because both investors and companies, they have to plan, and this doesn't really support that all that well.
Well, and just to add to that, because I'm sitting here in Toronto, and the conversation for the Canadian economy is that coming into the year, things looked relatively good, but all of a sudden there is a extreme fear about what tariffs mean for the economy, which, you mentioned that word growth scare. Let me try to put four ideas together. Tariff threat, growth scare, rate cuts, and stimulus. And what I've been even hearing from some of our guests this morning is, while there is a real growing concern about the economy, if we're going to see accommodative rate policy and governments ready to act with money, then you might want to think about what that means in terms of where people put investment dollars as we start to move through the year. Is that fair?
No, that's absolutely fair, and it's actually a great synopsis. It's kind of interesting what you're looking at right now is investors, global investors, enter the year, everyone realized, okay, U.S. stocks are at really peak valuations, and they did start to reallocate to other parts of the world, and Europe's been a recipient of that. But it's interesting to keep in mind, you would say, first of all, how worried are investors? In many respects, they're actually reacting very, very constructively here. And I'll just say, like, all of the countries that are targeted with tariffs, whether it's Canada, Mexico, Europe, China, all of their stock markets have done much better than the U.S. and by a long shot. And Europe's in double digits. Canada's up 2.5%, 3%, but whereas the U.S. is negative. Mexico is up 9%, and these are MSCI, which equate for the dollar, and MSCI China, which is unequivocally benefiting from Deep Six, is up about 20%, right? So you have investors that are cautious, but to your point, Europe, the attraction with Europe was because it was a value play based on multiples. And the ECB was expected to be a lot more aggressive, and that's playing through. Now they've got a second leg from the fact that there's going to be a lot more defense stimulus. And it was a game changer this week when Germany came out and said, we are going to change our constitution so we actually can do defense spending. It won't count against the constraining debt limit. And that's a big change. That would be a huge change for Europe in terms of this unification, that fiscal stimulus that would come through.
Yeah.
So you're absolutely right. Investors are looking at those trade-offs. They're not running for the hills. They're just seeing where is their value right now in this market.
And that's helpful, Dec. And unfortunately, we're almost out of time. But I'm hoping we could show our audience like a longer-term chart of whether it's the Canadian stock market or the S&P, because you go back to COVID. massive growth scare, which is quickly followed by accommodative rate policy and stimulus, and the market goes zoop, and then goes right back up. And I wonder, the market has not, it certainly hasn't collapsed. I think it's even a stretch to say it has corrected if you're looking at the S&P 500. Is it possible, though, that we might see more of like a teacup kind of move here, where we sort of start to move down, but then we baseline and move back up? In other words, do you think the North American stock markets could end the year higher than where they are right now?
I absolutely do, and the allocation you've seen even within the S&P is more defensive, and those defensive sectors are doing well. And in that vein, Canada is one of those defense sectors in terms of the sectors that's in the index. So absolutely, you can. So we need to get uncertainty down, and then there is that room for recovery.
The big caveat there, yeah, for sure. All right, Dec, thanks very much. Appreciate your time. Dec Mullarkey joining us on the markets, and then beyond equities.